What's going on, guys? It's your boy Matt, back at it again with another trading related video. In today's video we're going to be talking about a very important topic, which is how to collect data from the stock market and how to use those data points to come up with a viable, profitable trading strategy. Now, in today's video I went ahead and prepared a slideshow for you guys. I want to make this videos a little bit more interactive with you guys. So what I will do is I'll be asking you guys some questions and I hope you answer it truthfully to yourselves, so that way, we can learn something from it as we go through the video, right? Now, the next thing is, if you have not already subscribed to my channel, please do so. It'll help me grow the account. It'll help me put out better educational materials and share more of what I have. And for those of you guys who are not in the chat room yet, I have a free chat room on Discord. I'll put the link down below. Please make sure you click on it, come through, say hello, and we all can learn something from each other. Thank you so much, guys. Now enjoy the video. What's going on, guys? Today we're going to be talking about a very important topic, which is how to collect data from the stock market and use those data points to come up with a viable, profitable trading strategy. And I know some of you guys have been asking me to make a video on this particular topic, so here it is, and I hope you guys enjoy it. So the first question that I really want to ask you guys is, what is a trading strategy? What does it mean to you? For me, the answer is pretty simple. A trading strategy is a method of buying and selling an asset based on a set of predefined rules to make money. And I really want to emphasize on that predefined rules. And I guess the simplest way that I can explain that is by using casinos as an example. So let's say you go to Vegas, walk into one of the casinos, and you decided to play a single hand of blackjack. On that particular hand that you're playing, no one knows what the outcome is. No one knows whether you're going to win or the house is going to win, which makes it a gamble. But we know for sure that casinos are not in the business of gambling. They don't gamble with their money. They know at the end of the year, they're almost guaranteed to generate money. And why is that? And the answer is pretty simple. They have a set of predefined rules for the games. When you play in the games, you have to play within their rules. And those rules would give them an edge in a long period of time, right? Over many hands being played, it gives them an advantage. That's where the edge lies. So when you come to the stock market and trying to formulate a trading strategy, do not try to go for a strategy that's going to work 100% of the time, because that never exists, right? You want a strategy that's going to make you money in a long run, right? Now, naturally, the second question I'll be asking you guys is, what is your trading strategy? What strategies do you use when you come to the market every day, right? And some of the answer would be, pre-market breakout, parabolic shorts, washout longs, meta style, and so on. And I'm pretty sure if you guys go into some of the chat rooms, you would hear a lot of trading strategies being thrown around, all right? Now, the second question, you guys probably already guessed it. How did you devise your trading strategy? How did you come about your trading strategy, right? And the answer to that, there could only be a certain amount of answers to that. And one of them could be, you notice some patterns happen more frequently as you're trading and you decided to adopt those, patterns as your trading strategy. Or you're simply trying to utilize another trader's formula and attempt it for yourself. Or it could be directly following someone else's trading advice. The point is, all of this information you received must have came from someone or something, right? Now the question is, if those information came from someone or something, is how do you know that the strategy you've been told or you've observed works for sure, right? How do you know it's just that one time it worked or twice it worked? The answer for me is very simple. The answer lies within collecting data. That's how you find out. Now let's talk about data. What is data? What does it mean to you guys? For me, it's a collection of objective facts that will give you an unbiased truth into whatever you're trying to find out. Whether you're trying to find the strategy works or not, data. Now, there's two ways of collecting data. The first one is qualitative data. It's non-numerical data. An example of that would be, what's the texture of the table? Is it soft? Is it rough, right? Second one is quantitative data, which is a real hard number to come up with solutions. And when we try to formulate our trading strategy, we'll be using both ways of collecting data, right? The next part is why is data so important? Why do a lot of profitable traders really emphasize on collecting data? I mean, you guys might have heard him saying, according to my data this, according to my data that. And the answer is pretty simple. That's exactly how you find out whether your trading strategy works or not. How often your trading strategy works. It helps you define your strategy. It helps you better mold your strategy, right? It helps you establish risk levels. It helps you come up with profit levels, entry levels, add levels, exit levels. All of those things you will find the answer within the data you collected. It tells you exactly how often your trading strategy works. Does your trading strategy work 70% of the time? Or does your trading strategy work 80% of the time, right? And also collecting data itself is backtesting a set of strategy, right? It's backtesting that strategy. And once you collected that strategy, you can future test the strategy. It helps you do that. And we all know, a big portion of trading is trader mentality, trader psychology. Just knowing how often your trading strategy works, knowing your entries and exits, ins and outs of that particular strategy would help you execute the trade with just a little bit more confidence, which is a massive boost for your trading psychology, right? It's a massive boost for your trading psychology. So that's why data is very important. In general, it helps you become a better trader, right? The next thing I want to discuss about is, before we really get into my data, what are the myths surrounding data and trading strategy itself? Now, the first one, you guys might have said this in the past, or you might have heard someone saying it in the trading rooms. It's, I've seen this happen a million times before, and it works. Now, the problem with that is we know that human memories are notoriously unreliable, especially when it comes to details. And don't take my word on it. Go out there and do your own research. You would quickly find out. In fact, prompting to remember more can lead to generating details that are outright false. And to prove that, we can run a little test. I want to ask you guys a question. Do you remember all the stocks you traded last week? I'm not asking you, stocks you traded a month ago or a year ago. Just last week. Do you remember all the tickers? Do you remember what the news were? Do you remember what the price were? Do you remember what the pre-market high, pre-market low was? Do you remember what the day high, day low was? Do you remember the details, like what time was the day high, what time was the day low? Do you remember the difference between the percentage difference between the opening price and closing price? Do you remember how it moved? Did it drop shorts and went higher, or did it went to the pre-market high and got rejected? For all the tickers you traded last week, the answer to that is no. You would not be able to remember, because you're a human being, not a data machine. So when someone says to me, I've seen this happen a million times before and it works, sorry mate, I don't trust your memories, right? The second myth that you guys hear a lot about is, it works for other people, so it should work for me, right? In fact, I had a conversation with one of the guys in the chat room the other day. Some of you guys from the chat room would know that he was telling me that Mark made $1 million using this strategy, so I'm trying to make $1 million too, while he's losing money. And the problem with that is, yes, Mark might have made $1 million, but Mark might know information that you don't know, that you're not a preview of. You probably don't have a complete picture of how that strategy works. If you trade 10 trades, if you take 10 trades, you might make money 9 times just like Mark does. But when Mark avoids that 10th trade per his strategy, you might take that trade in, lose everything you made, plus more. So the question is, are you willing to put your hard-earned money on the line just in the assumptions that Mark might have told you all the information you need to know about that strategy or not? If you're a profitable trader, the answer should be no. You should be able to walk your own path, collect data to prove it, to know all the information that you need to know. That's when you can for sure say this strategy works or not. For me, I follow the simple steps. You have a trading concept. Trading concept could be, you've seen someone execute a trade in a particular way and you want to use that, or you did a course of Ross's course or whatever, and you have an idea of what a pre-market breakout is. So what you want to do is, you have that trading concept and then you want to collect data on it. Once you collect data on it, refine it.
What are the entry points? What are the exit points? What are the risk levels involved? Once you refine that trading strategy, you want to back test that strategy. Go back 3 months, back test it, see if it works. Once back testing works and it checks out, future test it. For the next 2 weeks, try to implement that strategy, see if it works. And if only then, when that checks out, you'll be able to put your hard-earned money on the table and implement that strategy on a daily basis as you trade. Right? These are the steps that I follow. You guys should do the same. Now, let's really talk about my data that I've been collecting. It's a gap and crap. It's a short strategy. You guys might have heard of this strategy itself, but it's pretty simple. Now let's talk about data. But before we really get into it, I really want you guys to know that collecting data is a very ugly work. It's a very time-consuming. It's a very hard work. It requires you putting data points one at a time into a spreadsheet. It takes a lot of time. I myself remember a lot of sleepless nights, a lot of trial and errors, right? So it's not an easy work, but it must be done. And I'm not sitting here claiming, my data is the best data out there. I'm pretty sure there's a lot of profitable traders out there who got better data and they know how to approach it better than I do. But for me, this is how I approach this problem. Given the fact that I have not seen their data, I have not seen how they do it, but I know they have data. So this is how I approach it. And the reason why I haven't seen their data is pretty simple. No one out there wants to give you data they painstakingly collected over the years for free, right? But that is why I was really inspired to make this video for you guys. And I know some of you guys in the chat room have asked me to make a video on this particular subject, and I appreciate it. And for those of you who are not in our Discord channel yet, I'll put the link down below. It's free. Jump on. If there's any topic you want me to make a video about, just pop in the chat room and ask me. Right? Now let's talk about data. When collecting data, you need to be very specific, right? You need to have controls. You cannot just collect data on anything and everything that moves, or else your data will be loosey-goosey. There's no point. And the reason why you need to be very specific is pretty simple. We know large caps trade differently than small caps. We know a stock out of 25 cents different trades differently than stock above $10. We know low floats, trade different than bigger floats. So we know different things would contribute the stock to be traded differently. And you want to approach this, with a magnifying glass. You want to be very specific. That's why you need to collect different data on different strategies, and you have to be very specific about it. So to be specific, you need to set a set of requirements, criteria for the stocks to meet before you put them into your data, right? And for me, for this gap and crop, the one I'm giving out today, it's pretty simple. The first one is the stock must have 3 million pre-market volume. And the reason why that is, this gap and crop is a short strategy, right? The more crowded people it is pre-market, the better it is. Because when it opens, it's not going to go parabolic, because it's not going to start skipping $2 or $3 on your face when you're short, right? Because some of the people who are short pre-market would want to get out market open. So it's not going to be as explosive as, low float with, 1 million, 2 million shares. Ross comes in and scoops up, 100,000 shares, and this thing is $10 before you know it, right? It prevents, when it's crowded like that, chat rooms would not be able to push it, right? There's no that fake volume push manipulating stuff when the volume is crowded. That's one of the reasons. The second requirement for this gap and crop strategy is stock needs to be 70% plus, ideally 100% to 100%. The reason for that is you don't want to short stock that's up only 10%, because then there's no profit, right? There's no profit margin. But if it's up 100% to 100%, there's a lot of meat on the bone. You need that. That's when you short, right? The second requirement is the price needs to be below $6, and the major reason for that is risk management, right? If you're trying to short stocks like SPI, you would have to implement a different risk management than stock that is trading like $5, $6, or Kodak, for example. You need to have a different risk management in place for those kind of plays, right? So this, having it at $6, it caps it, so it prevents you from getting stuck into like SPI or something like that, right? So that's one of the reasons. The other ones are not a must, but they're ideal. So you want this thing to have an ideal 50 million plus float. Larger float, the better, because as a short seller, it contributes to your side, right? Ideal to have dilutions if they have offerings, ATMs, warrants, and hidden ATMs, or so on, right? If the company themselves are dumping shares, it's better for you, and there's a way to establish that, whether they're going to offer or not, right? It's ideal if there is a solid resistance level on a yearly chart, right? So that way you'd be shorting it as it's slamming up into a resistance level, right? Because you're risking that resistance level, and so on. So you want as much as a lot of factors to the short side as possible, right? Now, what to look for? Just because those criteria are met, it doesn't mean a straight away short. You still need to zoom in again and specify your entry levels. For entry levels, you need to look for weaknesses on level 2. So it's pushing up. Don't just randomly short it because it's below $6 and it has 3 million volume. You need to look for weaknesses on level 2s. Look for backside, right? You start shorting to the backside of the move. Look for buyer's exhaustion. You look for resistant levels on a yearly chart, right? Size in only when it's the backside. You can dabble in a little bit, have a start at the front side, top of the front side, right? Resistant level, but really size into the backside and let it run down. Do not short into support levels. So if there's support level that's at $5 and this thing is coming, hitting at that $5, don't short into that because it could bounce and you might get shaken out of your position, right? Short into the pops. But if it breaks $5, breaks that major support level, breaks and goes down, you can hit the beat on that one, right? And so on. So again, just because the set of requirements are met, it doesn't mean you just jump on shorting. You need to zoom in again, have your interests very specified and your risk levels. Thanks for watching, guys. That's just the simplest version of it. Let's get into the actual data that I have. Now I'll be giving out the template form of the data that I have collected for a long time now. So if you guys want to get that format, please follow me on Twitter, which is Matt3G3. Follow me on Twitter and DM me on there. I'll be able to send you the format. All right, guys. So this is the actual data on a gap and crap strategy that I've been collecting for a while now. I'll just go through it all and explain what each one means and why those things are important. Now, the first part, as you guys can see, this pink shaded area, this right here, is just stuff that I collected on pre-market, right? So the ticker name, right? So we have the ticker name. We have how much they gapped up on that day. We have the pre-market low. What was the lowest point on pre-market? What was the pre-market high? What was the highest, highest level on that pre-market? Was it a parabolic move pre-market or not? Meaning, right? Meaning, so this right here, that is considered a parabolic, right? Whereas something like this, not so much parabolic. So I'm trying to differentiate whether it moved like that pre-market or moved like that, right? And was there a fail follow through? Was there a fail follow through? Was there a fail follow through or not? What a fail follow through means, something gups up, right? So you guys can see right here, this thing, it popped up kind of almost parabolic, and then it popped again. It kept pushing. Every time it dips, it gets bought up, and it has follow through. Whereas this one, it popped up, dropped. Every time it attempts to come to the high, it got rejected, right? So did it have a fail follow through? So something like that you're looking for, right? What was the pre-market volume? Now the pre-market volume is important because you can compare the pre-market volume with the all-day, market open volume, and you can try to find out the ratio. And if you do that in a long period of time, you'll be able to kind of come up with the number to predict. Looking at the pre-market volume, you'll be able to find a relation between, okay, if it's traded this much, generally they trade 10 times the amount they would be trading pre-market. So if it's traded 1,000 pre-market, then it would be traded 10,000 plus market open. Okay? So that gives you an idea of whether the volume has. So if you're expecting 20,000 volume, but it's only 5,000 volume, you don't want to start shorting it because majority of the volume hasn't come through yet, right? So those are the things, and these things are, even though all of them meet those 3 requirements, they are divided in 4 different groups. Right. The first groups are new high, which means this thing broke the pre-market highs and went to see a new high, right? And those ones are simple. I'll just show you guys here. I'm talking about something like this. So they broke the pre-market high. That's the pre-market high. They went higher, right? It broke the pre-market high, went higher. Broke the pre-market high, went higher, right? The second groups are the ones that broke the pre-market, but they got slammed down in complete rejection pretty quick, right? And those ones are something like this right here. Something like this right here, where it popped, slammed back down, popped, slammed back down, right? Within the first couple of minutes. Look at this. It did break it, slammed back down. It did break it, slammed back down. So I'm looking for something like this where it broke it, but it got rejected immediately and washed out all day, right? And the third group are the one that tried to push to the pre-market high, but never really reached the pre-market high. Now, to establish this kind of difference is pretty good because it would give you an idea where you should have started, right? Majority of the time, do they actually reach to the pre-market high, or they failed before they reached the pre-market high? If the case is they never reached the pre-market high, then you can have an early starter. But if majority of the time they actually do come to the pre-market high, break it, go higher, or break it, reject, then you can start waiting for the pre-market high to get there before you have these starters. And the other ones are all day washes, and those ones are pretty simple. Something like this, where it went up and washed down all day, looked nothing. And you'd find some of these have dilutions all day, right? So they popped, they just slammed back down. Popped, you know, look at that. Popped, just wash out completely. It popped completely, wash out, fall apart. It popped completely, fall apart. So, and these ones are the ones, you know, that were a little bit off, but they went higher. As you can see, the red ones are the ones that closed red on the day, and the green ones are the ones, you know, that closed green on the day. Now, all of that information is just information pre-market, right? The next one is the pre-market high break. So this is market open. All of this green area is market open. This is information that I collected during market open. So market open, did they break the pre-market high? So that one is telling me, yes, it did break the pre-market high, or no, it didn't. If you guys can see, this group did break the pre-market high. This group did not. And some of this did, and some of this didn't. So if you're trying to find out, you'll be able to tell the, you know, how often do they break the pre-market high, right? That's how you discover it. And this part right here is, when did it break the pre-market high? When did they break the pre-market high? As you can see, the ones that actually went green, they tend to break the pre-market high after 10, right? After 10 or 3 in the afternoon, 10 or 3 in the afternoon. Whereas the ones that actually close red, majority of the time, they break the pre-market high within the first 3 minutes, right? And they get rejected. And some of them never broke the pre-market high, right? So these are signs that give ideas that you would have. If you see this thing is failing to break the pre-market high, you'll start thinking, okay, it's most likely going to close red, right? And the second part is, if you decided to, you know, if when they go from the open into the pre-market high, how much was that bounce, right? This thing, it was, I mean, if you look at, I'll put the chart here as well. If you look at the open area, you know, it was about 10 cents, right? So it broke the pre-market high, poked up 10 cents and slammed down, right, out of the gate. This thing, you know, this thing's went 30 cents. It broke the pre-market high, went 30 cents and rejected. So I'm trying to find out, on average, how much after they break the pre-market high, how much higher do they go? Do they go $1, $2, 20%? Now, if you guys see the ones that went green, they break the pre-market high and they go up to $4. But the break, where they break the pre-market high, the timing is around that. But this is just one signal. You combine that with the volume and other stuff as well. So the next one is, what's the opening price? And the next question is, I'm asking, if I shorted within the first 3 minutes of the open, would I be in the money? And the majority of the time, yes. And some of this, no, because they actually never broke the pre-market high, right? And this one, some of these, yes, some of them, no. So that kind of gives you an idea. And now I'm trying to find out on the timely basis, what did it do at 9:40, right? Market open at 9:30, 9:40, what are they doing? Did they break this is a pre-market high, where it went pre-market high, it put a new high and slammed back down? Was it at a pre-market lows, right? Was it at a pre-market lows, right? Pre-market low support. So pre-market low support meaning right there, the pre-market low support. So you have the pre-market here, that's support, right? On 9:40, what happened? Did it snap it? Did it support it and bounce? Those kind of things, right? As you guys can see, I'll get into it. But I'm trying to find out, did it based on 9:40, right? What did it do? What was it like, right? At 10 a.m., what did they do? When did they put the day high? When did they put the day low? So I'll put, if you guys really want to know what each mean, what all of those things are, just, contact me and I'll be able to answer. But for the time's sake, I'm just going to skip it. What was the day high? When was the day high set? At what time was the day high, right? That kind of gives you an idea of where they usually peak when certain things happen, right? If you're trying to do a reversal, what time was the reversal? For this one, a 940 was the reversal, which means, let's take a look at it. Which means the reversal was right here. If you bought this, see how it held the pre-market. So establishing whether it broke the pre-market high or not is good. If it supports the pre-market lows, right, the pre-market lows, and it starts to bounce around 940, it could be a long using the highs, right? So those are the kind of things that I was trying to figure out. And did it break the pre-market? So this one is when did it break that? When it peaked. This one here is the reversal. At what time was the reversal, right? This one, the reversal was at 940.10. So within that 940.10 is where usually the reversal is, where that little bit of bounce is, right? The next one is, did it break the pre-market low, right? The pre-market low didn't break, and majority of the time, yes. The ones, if you guys notice, the ones that actually closed green, majority of the time, yes, they did support. They didn't break the pre-market low and they went higher. I mean, if you guys look at other stocks as well, like Kodak and all that, they did the same thing. So if you're long, how much would you have made on it, right? If you bought at that pre-market low support, how much would have bounced? This one you would have made $5, $3 on average, and some of these you would have never made money, right? So trying to find out whether playing that it has good money or not. When was the pre-market low? All right, so this one right here is trying to find out when was that pre-market low break, right? At what time? This one is when did it break it? This one is when did it break that pre-market low, right? If you guys can see around that 10 area, this ones are the ones that completely washed out, but that 10 area before 10, you don't want this thing to wait until 11, right? You want them to break it before 10:30. You want the pre-market low to break and wash out. If they keep holding, supporting that pre-market low up to 11, they tend to reverse. So that's the kind of thing that I'm trying to find out here. What was the morning low, right? What time was the morning low? So if you're shorting the highs and you want to take a profit, so let's say you shorted this, you shorted somewhere here, and you're trying to take a profit, at what time do they usually put in the morning low, right? This part, at what time does it usually happen, right? This part right here. This part right here in this case. So that's what I'm trying to find out. So I will be able to take some profits in the morning, right? What was the morning low? What was the price of the morning low, right? So this is that before afternoon kind of play. This one is trying to find out what was the all-day low price. I mean, what was the all-day low time, right? At what time did it set the all-day low, which is where you really want to take money. And if you'll know that most of the majority of the time, if you're shorting, out of the gauge or in the morning, you want to hold it all the way to the afternoon, because majority of the time, the lowest point on the day, the ones that wash out, is from 2 p.m. to 4 p.m. to the close. And as you can see, this is the area that I'm talking about, the low area. If you shorten that, the low areas. This areas happen in the afternoon, right? This areas happen in the afternoon, right? Now, and that's at what time it was, the all-day low. So the morning low and the all-day low are different. The morning low is what was the lowest point before afternoon, and this one is what was the lowest point in all-day trade, right? The all-day low, and on what time that it happened. So as you can see, you can clearly, the ones that actually closed greens, the after morning low, they went higher, right? So the morning low is at all-day low was at 940, which is in the morning, same as with the morning low. Whereas the ones that actually closed red what was the all-day low price? Did it, did it close? Did it close higher than the all-day low? So would you take it at 2 o'clock, or would you take it at 4? Did it close, higher than the day low or lower than the day low? Which means that closing price, should you wait until the closing price? Is that closing price lower than this part? Because sometimes, as you guys can see, this is the lowest part, but it closed higher, right? So should you wait until the closing, or should you wait, until it holds? Um, so that's what I was trying to find out here. The next thing is, what was the all-day high? Now the all-time high means this includes the pre-market high. So pre-market high or day high, which one is the highest? We'll trade with the highest. So pre-market high, if it went to 10, but during market trading hour, it went up to 8, the highest point, then I'll take 10 in this case, because that's the highest price it ever went in today's full trading session. All right, now did the stock close red on a day? Did it close green or red? As you can see, majority of the time, they close red. What was the closing price? All right, so all of those are data points. Now, this is where I try to find the relations between those data points. The first one is what's, between the pre-market high and the closing price. So if you're shorting pre-market and you're shorting the pre-market high, and you're trying to take profit at the closing, how much would you have made money? Right? So these are the percentage differences between the pre-market high and the closing price. What was the percentage differences between the opening price and the morning low? So should you start taking some profits in the morning lows, right? And the answer to that should be depends, but for me, no. You should wait. The data says you should wait until the afternoon, because look at that. You'd only be making 8% profit from the closing. Whereas if you waited for the all-day low, you'd make 39% profit. So if you're taking profits usually in the morning, it means you're leaving a lot of money on the table, right? So you want to be taking, this is the difference between open price and all-day low. This is the difference between, open price and morning lows, right? So the all-day lows are the better ones, and we know usually what time they happen, the all-day lows, right? So to wait until that afternoon 2 o'clock, 4 o'clock comes is really kind of important, or else you're leaving a lot of money on the table, right? Especially in some of these, look, 24, that much, you're leaving a lot of money, 1%, 10%. So those are the relationship. This is the pre-market high to all-day low, right? Pre-market high, all-day low. What are the differences, right? This one here is retracement. Retracement means, so in the pre-market, it gapped up between the difference between the opening price and the pre-market high. So it popped up, let's say it went to $10 and it pulled back and opened at $8. So what was that retracement, right? How much did it pull back? That kind of gives you an idea, because in some of this, the ones that really wash out all day, these ones have, if a stock has a lot of retracement, example like this, you see a lot of retracement before the open, they usually don't pop up. They usually just continue to fall apart, right? I'm trying to find out those kind of information. Whereas the retracement on this is not as much. Retracement in this is not as much. Retracement in this, not as much. So they did try to, push up a little bit to the pre-market high. So those ones kind of refine where your entry point should be, right? And, what was between the opening price, the pre-market high price. So this is another really important point. So the ones that broke the pre-market high, after they broke the pre-market high, this comes into a risk level. After they broke the pre-market high, how high did they go? Right? It broke the pre-market high. How high did they go before they? Some of them, as you guys can see, did break the pre-market high, right? This one broke the pre-market high. This one broke the pre-market high. Broke the pre-market high. But it didn't. If you guys take a look at, but look at this one. It broke at the pre-market high. It went to $9, right? This one did break the pre-market high, but it pulled back. So I'm trying to establish, I don't want to cut it, because I know majority of the time they do break that pre-market high. I don't want to just cut it at pre-market high. I want to give it room to find out whether it's going to be one of those that's going to retrace, or one of those that's going to go to $9, $10. That's where you find out if you know on average how much they go after breaking the pre-market. As you can see, it's usually below that 20%. 25-20% doesn't mean a lot, because we established already the stocks that we're trading here are below $6, right? I have a separate data, the stocks above $9 and plus. You can use this for up to $7 as well, $7, $8. But you gotta be careful with those ones for a pre-market high break strategy as well. That's a separate strategy that I have collected data on. But stocks with this ones, 20% means 20-30 cents after they break the pre-market high, right? That's what I was trying to establish. So if it breaks the pre-market high, I don't want to just panic out. I don't want to think this is gonna run up to $9, $10 plus, right? I want to give it that room where, okay, if it doesn't, start to put in a backside after 20% or 25% after it broke the pre-market high, then I'll start to think, okay, this might be the one that's going to go to 9. But that's not the only data point. You got to combine that with volume, because volume trumps everything, right? So you got to combine that with volume and other trading strategy, other trading informations to execute that trade. Now, this one here is what was the difference between the opening price and the highest point, right? As you guys can see on this particular, the pre-market high, after breaking pre-market high, it went only 9%. But between the high and the opening price is 37%. So usually good to wait, as you guys can compare this number, it's usually good to wait for that pre-market high area rather than the opening, right? So what's the difference, the relation between the opening price and the closing price? Majority of the time, as you guys can see in these things, they close red. But the ones that close green, they do close green 200% from the open, 150%, 70%. So they go dramatically highs, right? So the point is, how do you differentiate the ones that's going to go after they broke the pre-market high, they go 20%, and then still go 200, 300% after that, or the ones that break it, go to 20% or 10%, and then retrace back, right? And what was the volume? The volume is important because, first thing you start to establish, the ones, these are all in millions. So the ones that really close green, they have like 200 million, 80, almost 100 million, 20 million. So you start to see that they have a lot of volume. That's the first thing. The second thing is, if you have this volume in a long period of time and you also collected the pre-market volume, you can find the ratio. This ratio tells you what the ratio is between the pre-market volume and the market open volume, right? And you can give it a bottom baseline where I would take 10%, 10 times, right? On average 10 times. So, if the trade, as I say, 10%, then you would expect, if it traded 1,000, you'd expect 10,000 on a day, right? So that kind of thing. End of the day, did it close? Was it the low? Yes or no? So end of the day, from when you would have shorted, would it have closed low? Yes. The ones that closed green, obviously no. What was the float? Very important. And in relation, the float with the other information that I have it. What was the institutional ownership? That's another important, important information. How much did it pull back pre-market? What was the pre-market pullback, right? Now, what I found here is both in a short, so combine everything that I collected, I have more, that 81% of the time, they actually close red if they meet those requirements, where it's, 81% of the time. 18% of the time, they actually go and close green on a day. But the ones that close green on a day, we know they're good long plays because they close 200% or higher, right? So we know 80%. So out of the 20% of the time that close green, if you decided to play them long after they broke that 20% and you tried to play them long, expecting them to close, 200, 300%, how often would you be right about it? 60% of the time. So for from the 20% of the time where they would have closed green on the day, if you tried to play them long after they broke the pre-market high 20% and then you start longing them, you would make money 60% of the time. But that 60% of the time is a 200, 300, percent gains. Whereas 40% of the time, that sometimes they do pop over, 50, 60% above that 20%, and then they retrace back sometimes. But those are good things, because you can still reheat them. This is to give you an idea, to give you confidence, right? Sometimes it breaks the pre-market high, goes to 70%. It broke my 20% threshold. I would have taken my losses at that 20%, and I would wait. If it looks like it's putting a backside, then I'll still short it, right? And from the 80% of the time that they close red, if you're shorting within that 20% threshold, how often would you have been right about it? So 96% of the time you would have been right about it, right? So these are some of the data, but this is the data points. Again, guys, for every trading strategy, I have a data collected like this and sorted out. As you guys can see, all of these data points, and I put the charts as well, are put one by one, painstakingly through hand, every data point. It's very to automate this kind of depth of data collecting, right? The second thing that I did here was I collected all of the charts, right? And I put what they look like on a daily chart and whether whether they have a resistant level on a yearly chart or not, right? So what did it look like on a yearly chart, right? And also, as I said, I differentiated them by groups as well. So and then here more charts. What did they look like? What were the levels on a daily chart that I should be looking at, right? So all of these things gives you a very depth and look on that particular trading strategy. Now, thanks for watching, guys. I really appreciate it. I know this video has been a bit long, but I feel like it's really important not to leave out any information. Now, if you guys want to get the template of this data on this particular trading strategy, and you want to start collecting your own, but you want to use my own format, please follow me on Twitter. And contact me on Twitter. Follow me on Twitter. Contact me on Twitter. My Twitter is Matt3G3. Matt3G3. That's my Twitter. Make sure you follow me on Twitter and DM me and ask me on Twitter, and I'll be able to send you the format of this. And also make sure if you haven't already subscribed to the channel, please, my YouTube channel is that. Make sure you're subscribed to my channel, like the videos, make sure you comment below. It helps me put out more educational videos like this, and I'll be able to share the other data that I collected as well. As I said, it's very, very hard to collect this data. It takes a lot of time, over a year of collecting data like this. It helps out. So make sure you click the like button, subscribe, and make sure you follow us on Discord as well. Pop into the chat room. I appreciate it, guys. Thanks for watching.